All right, let's pull back the curtain on the financial markets. Today, we're going to get into the real game being played every single second. Let's find out how trading actually works. So, think about it. You're on your phone, you see a stock you like, and you hit that buy button. It happens in an instant, almost feels like magic, right? But what is really going on behind the scenes in that split second? Where did that share you just bought actually come from? That's the big mystery we're going to solve today.
Okay, the first thing you absolutely have to understand, the most fundamental rule of the market, is this. Every single trade is a deal between two people. You simply can't buy something unless someone else somewhere is willing to sell it to you at that exact same moment. It's always a dance between a buyer and a seller.
Let's make it super simple. Imagine you walk into a vegetable shop to buy an apple. For that sale to happen, the shopkeeper has to be there, right? And they have to be willing to sell you that apple for a price you both agree on. The stock market? It's just a gigantic digital version of that shop with millions of people playing the roles of both the shopper and the shopkeeper. And this is where the real tension comes from. See, the buyer and the seller want completely opposite things. The buyer is on the hunt for a bargain, trying to get the absolute lowest price they can. The seller, on the other hand, is trying to get every last penny, the highest price possible. This constant tug of war is literally what makes the market move. So where do all these millions of buyers and sellers actually meet up to hash out these prices? Well, they meet in a digital arena called the order book. This is the heart of the whole operation, where every single intention to buy or sell gets logged and organized. So what is an order book? You can basically think of it as a totally transparent, live list of what everyone wants to do. It shows every single buy order and every single sell order for a stock, all neatly stacked up by the price people are willing to pay or what they're willing to sell for. The way it works is kind of like a digital queue. On one side, you have the bids. That's all the buyers, lined up with the prices they are willing to pay. On the other side, you have the asks. That's all the sellers, lined up with the prices they're willing to accept. A trade only happens when a buyer and a seller meet in the middle, when a bid price matches an ask price. That's the moment of the transaction. Okay, we've got the players and we've got the playing field. Now for the most important piece of the puzzle. What actually makes a stock's price go up or down? It all boils down to a simple, powerful battle between two forces, supply and demand. And here's the crucial part. It's actually pretty straightforward. If there's a flood of people trying to buy a stock, but only a few people are selling, those buyers have to compete with each other. They start bidding the price higher and higher to get their hands on those limited shares. And the opposite is also true. If everyone is rushing to sell and there aren't many buyers, the sellers have to start dropping their prices to get someone's attention. The price gets forced down. It's really that simple. And this is where we get to the human element of it all. What causes these huge imbalances in the first place? It's human emotion, but on a massive scale. Greed, or that fear of missing out, FOMO, can create a buying frenzy. And on the flip side, panic, the fear of losing money, can cause a huge stampede of people trying to sell. At the end of the day, the market is just a giant mirror reflecting our collective hopes and fears. Now, when these big waves of buying and selling happen over and over again at certain price points, the market starts to develop, well, almost a kind of memory. Certain price levels become psychologically important, and they create these invisible barriers that traders call support and resistance. Think of support as a safety net or a floor. It's a price level where, in the past, a stock has stopped falling and bounced back up. And why does this happen? Because a whole bunch of buyers see that price and think, hey, that's a bargain. They all step in to buy, which creates enough demand to support the price and stop it from dropping any further. Resistance is just the opposite. It's a price ceiling. This is a level where a stock has historically struggled to go any higher. As the price gets close to the ceiling, a lot of sellers who bought the stock way cheaper start to take their profits. This creates a wall of supply that makes it really tough for the price to break through and keep climbing. So now that we kind of get the mechanics of the market, let's look at the different ways people actually play this game. Because trading isn't a one-size-fits-all kind of thing. It really comes down to your own personal style and your strategy. So what kind of player are you? It pretty much boils down to how long you're willing to hold on to something. You've got day traders who are in and out of a trade within the same day. They're trying to profit from really tiny price moves. Then there are swing traders. They'll hold for a few days or maybe a few weeks, trying to capture a bigger swing in the price. And finally, you have investors who are in it for the long haul, We're talking months or more often years, betting on the fundamental growth of a company.
So there you have it. You now know that every trade has two sides, a buyer and a seller. You know they meet in the order book, and you know that the imbalances between them, driven by good old human emotion, are what move prices and create these patterns. You now understand the basic rules of the game. But that leaves us with the biggest question of all. How do you learn to spot the patterns that could lead to a win?